One thing I'll pose to you, Jake, we get questions a lot of times from clients about different assets, and it can be kind of a tough thing to hold in your mind of, okay, we have some clients that might say like, hey, cash is really safe, and shouldn't we want really safe assets? So why wouldn't we just put it all in cash? Mm-hmm. And then we have on the other end, hey, maybe small cap value stocks have had historically really high returns. Like, should we just put it all in small cap value? And I wonder if you could speak to sort of, the different, what the role of the different assets are in the portfolio, mm-hmm. and do they have over long periods of time the same returns or different returns, or how does that work with all those different assets?
Yeah, that's good, and is a good segue off of what we just talked about with goals and plan. But you also, I think at the most basic level, I think the thing to do is to really define risk in each of these different assets, or each of these different tools to achieve your stated goal. So let's do that, right? So let's go both ends of the spectrum. Cash is risky for some people. U.S. small cap, U.S. small companies are risky for some other people. And then there's things in between. There's broad market, there's value companies, there's international, there's all these different things in between. But to start, let's go on the outer edge, and that's cash, and then that is U.S. small cap stocks, U.S. small company stocks. So cash, how is that risky? You always hear, that's the safe investment, right? Well, yeah, I mean, for some people it is. If your goal is within the first 3 to 6 months, cash is a good investment to own because there's low volatility to it. And I think that's the big reason why people assign that as a safe asset, because it's low volatility. But if I'm a 30 or 50 year investor and I'm trying to achieve one of those goals that I set for myself, I may not be able to get by on a 0% return. In fact, I know I can't get by on a 0% return. Yeah. So then what's the next step up? Well, I can look at some money markets and things of that nature, which today that's a good idea if your goal is within 3, 6, 12 months. Mm-hmm. Money markets, short-term treasuries, they're paying 4 or 5.5% just to give more of a range, and that's in 2024, right? Mm-hmm. As this video ages, mm-hmm. that will change. Yeah. But so that's where you start. What is my goal? What's my time horizon? Does this asset meet that time horizon? Quickly, to kind of put a bow on this, let's go to U.S. small cap stocks, or we can even just go to U.S. stocks in general and say, okay, well, first of all, you're in the stock market now, mm-hmm. so you are going to have more volatility. Absolutely. And as a segue to that, if you didn't have more volatility, I would be more worried about it, mm-hmm. because that means that stocks aren't acting like they should, mm-hmm. because we know that companies' earnings are different this quarter than last quarter. Mm-hmm. So there has to be some volatility.
Part of the price you pay to achieve those long-term returns is to stomach the volatility, and not just emotionally, but to truly have a time horizon that's long enough to endure the volatility, which not everybody does, and that's why stocks, 100% stocks especially, is not suitable for everybody.
And mm-hmm. if it is suitable for you and you can stomach that because you have a long time mm-hmm. horizon, that's your superpower.
Absolutely.
Time.
Yeah. I'm going to rattle off some nerdy stats here. So we can put this chart up on the screen. But the growth of a dollar, I think it's from 1987 to, I believe, the end of either 2022 or 2023. A dollar invested, just that would return inflation, would be $2.78, mm-hmm. Close to today. Putting it in, U.S. bond market, just the total bond market, a dollar would turn into $6.32, which is pretty good. Yep. 6 times your money. Putting it in large cap stocks, $1 would have turned into $41.85. Small cap value stocks, $52.04. So just to give everybody an idea of how powerful investments returns can be over long periods of time. Now, I'll tell you though, the ride along the way would have been much smoother in those bonds. And that's what a lot of people talk about when they say risk, is like, is it a bumpy ride or not? But to your point, so many dimensions of risk beyond just, hey, is it up and down a lot along the way? Mm-hmm. There's, hey, are you going to outlive your money? Right. Does this asset have the return potential mm-hmm. to be able to help you reach your goals?
And one of the biggest misconceptions is that, the first one that you said was inflation, and it comes to like $2.50 or something after that, which is still not a huge return. But if you're in pure cash, you're not even getting that. Mm-hmm. It's flat. It's mm-hmm. zero. I guess, are you adjusting that number by inflation? Or would that be like your
after inflation? But so if you take cash minus inflation, you earn like 0.2%
Okay.
over that time period. It's not very much.
So it's that's just interesting to me. And yeah, you're rewarded for the risk that you take in the stock market. So that's why those small cap stocks have returned so much more. Hey, thanks everyone for watching. If you enjoyed this video, feel free to click the link below to watch it in its entirety. We appreciate it. We'll see you next time.